Leaving Canada on a permanent basis is a significant life event, and from a tax perspective, it requires careful planning. The most important starting point is understanding your residency status, as Canada taxes residents on their worldwide income. Residency is based on your facts and circumstances. Even after you leave, you may still be considered a Canadian resident if you maintain significant ties, such as a home, spouse, or dependents in Canada. Secondary ties, including bank accounts, memberships, or a driver's license, can also be relevant when viewed together. Non-residency typically begins once those ties are severed. This aligns with the latest of when you leave Canada, when your family leaves, or when you establish residency in a new country. However, spending 183 days or more in Canada in a year can result in deemed residency, which can keep your worldwide income taxable in Canada. From a tax standpoint, the most significant impact is departure tax. When you cease residency, you are deemed to have disposed of your investments at fair market value, triggering capital gains even if nothing is sold. This applies to non-registered investments, private company shares, and foreign real estate, while certain assets, such as your principal residence and registered accounts, are typically excluded. RSPs and RIFs can remain in place and continue to grow tax-deferred, but withdrawals are subject to a 25% withholding tax for non-residents. TFSAs may remain tax-free in Canada, but are often taxable in other countries, which can reduce their effectiveness. There are also ongoing considerations after you leave. Rental income from Canadian real estate is subject to withholding tax, and selling property requires notification to the CRA. In addition, any outstanding balances under programs like the Home Buyers Plan must be addressed prior to departure. Some individuals consider deferring departure tax. This is possible, but it involves filing specific forms and potentially posting security with the CRA. While useful in some cases, it adds complexity and needs to be evaluated carefully. There are many planning items to consider prior to departure. These include using capital losses, triggering gains strategically, or reviewing ownership structures to improve tax efficiency. For business owners or those with trusts, additional considerations apply, including how ongoing control or involvement may impact tax treatment. At the end of the day, emigrating from Canada involves more than just a physical move. The tax implications are broad and technical, affecting your investments, retirement plans, and real estate. With proper planning and coordination, you can reduce unnecessary tax exposure and ensure a smoother transition to your new country of residence. If you like this video, you can discover more videos in the Greenard Exchange section of our website. You can also read both past and current articles in the Greenard Index section. Thanks for listening.